This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. As always, my name is Alex Perny, and today we are very pleased to welcome on Josh Green, founder of Alchemy Design and Development and Traverse Capital. We're going to be talking about a subject that I feel really probably doesn't get as much press as it deserves, but townhomes as a medium for investment. It's something that we all see in our communities, but I normally think of investing in like single family, or you think about getting a larger multifamily. Whereas there's that spread in the middle of the townhome to the duplex, duplexes and triplexes get a lot of press, but the townhome market, I really feel like, is kind of underserved, and I'm really interested to learn some more about it. So Josh, thank you very much for being on with us today. If you wouldn't mind, give us a little bit of background about yourself, and then we'll jump into the topic at hand.
Sure. Yeah, no, thank you so much for having me. I'm excited to talk to you. So my background, my name is Josh Green. I am based in the Salt Lake City, Utah area, kind of born and raised in Utah. My background is I was an apartment appraiser and consultant for over a decade, working all over Utah, kind of surrounding mountain states, Wyoming, Montana, Idaho. As part of that, appraisal is kind of a tough job to have. Everyone's kind of always mad at you. The value's never high enough, but I really loved the consulting side, and I was working with developers, helping them really figure out what was the best use of their property, and kind of building kind of a blueprint to give to them, saying, hey, I think this is the best use of your property, this is what you should build, this is the income expenses you can expect. And so after a while of doing that, I decided that's really where I wanted to be. And there was a lot more potential, earnings wise, to be on the developer side versus a consultant, and just make a small fee for my expertise. So I went back to school. The University of Utah has a Master's of Real Estate Development program. So I went through that program, loved it, learned a lot, met a lot of great people, and went to work for a local developer here when I graduated. And, I was doing all their underwriting, market analysis, debt equity on everything from kind of 3-unit infill townhome projects all the way up to 200 plus unit communities. And I've always wanted to do my own thing. And so a couple of years ago, kind of coming out of COVID, decided it was now or never, and made the jump to try it on my own. So
fantastic. Well, I would wager to guess that there's a lot of people have some aha moments when it comes to their current franchise in real estate. And that's kind of what I like to explore with a lot of people. You came from the appraisal side, which is interesting in and of itself. I think there's content for. I don't think I've had a commercial real estate appraiser on to talk about the ins and outs of commercial real estate appraising. I mean, to some people, I find that stuff fair. I mean, then again, I'm also the guy at our company that they give the new tax law legislation to, and they're like, "Hey, read this," and I'm like, "This is awesome." So maybe I'm the outlier and the black sheep that kind of finds that stuff interesting. But, the devil's in the details. There's a lot that can be gleaned from whether you're looking at kind of, market health to trends to just kind of, the building blocks of when it comes to investing in commercial real estate by understanding how these things appraise out. If you can understand the value basis of what, derives the value in a particular market, everything else, I think, tends to be, well, again, I personally have never done, a ground up syndication or development, but, I would wager to guess, by not having any firsthand experience, that would definitely ease things into it and make things a little bit easier. But with that said, coming from the appraisal background, going back to school, getting your master's, and then kind of coming into where you are now, what was kind of the driving force that made you want to kind of single out the townhome market? Because real estate's awesome, but the problem is that there's so much to do. It's kind of hard to, people get analysis paralysis, like, oh, there's so much. What do I do? How'd you kind of land on that? And maybe were there some stepping stones that you said, hey, this did work, this didn't work, this is why I'm gravitating towards this?
Yeah, no, great question. And I mean, townhome as a rental, and an investment, option. Like it's always existed, right? But it's gotten a lot more attention recently. But I guess just when I was doing appraisal and consulting, I got to work on every type of multifamily, from small multifamily all the way up to you know 300 unit projects, kind of everything in between, and every type, affordable, market, student, everything basically. And for some reason the townhomes always just stuck with me, and maybe it was me thinking about if I was going to live in a rental unit, which of all these products that I've been exposed to, like where would I personally like to live with my family? And it was the townhomes, and you saw the difference in rent that they were getting versus more traditional apartments, and just the feel like of having more space, and it felt more like a home. And there's some developers here locally that were early adopters of these modern townhomes for rent, and I just loved everything that they were doing as I saw it kind of come out of the ground. And yeah, that's kind of why, and, we can get into, there's a lot more reasons why I think it's a great investment opportunity. Just they're easy to build, the costs are, manageable. You can lease them up as you finish buildings. There's a lot of reasons why I like that product. And I think there's a ton of demand for it too, from the rental community.
Certainly. So let's kind of look at that from the perspective of, saying, okay, there's a lot of different ways to frame this. There's, no pun intended, but you have, kind of the development play, the acquisition of existing, the reposition play. It sounds like to me from what you were saying that you're kind of focusing on the development aspect of this. Is there a reason why you kind of centered on that versus the, the acquisition or the repositioning play on these kind of properties?
Yeah, I think for me personally, I'm a pretty analytical person. Obviously the appraisal background. I love, financial modeling and, working in Excel. But I also have this like really creative side that like wants to, create something, see something, built from the ground up. And so that's really what attracted me to ground up development over, like acquisitions or, value add, some other opportunities. It was really like being able to create something from nothing that kind of drove me that direction.
No, absolutely. So now, at least is that, do you feel like that's kind of centered to your market, or do you feel like that it's kind of a broader sense of the market is that the development play, at least right now, is a little bit more attractive across the board?
Yeah, I think so. I've talked to, and, see posts on LinkedIn and other places from, groups that were more traditionally, kind of value add or acquisitions. And the feedback that I'm hearing from them is that it's getting harder and harder to find deals that make sense that way. And, there still is, maybe a little extra margin if you take on the risk, I guess, of development going ground up. There's a little extra margin if you take on that additional risk and time.
Yeah, and would you say that the the deals kind of the deal flow restriction is mainly due to pricing or like money costs? Like, what's really kind of squeezing those cap tables for people that are on the development or on the repositioning and acquisition side?
Yeah, I really think it's interest rates. What you can borrow money for versus cap rates. And interest rates are in most places for most asset types a lot higher right now than cap rates. And so that's the challenge for everyone. Even on the development side, financing costs are still a challenge. And there's a lot of projects here, where I'm at in Utah that have been put on hold because of the challenges of financing costs. So I think it's the same challenge kind of across the board.
Great. So when it comes to kind of the development side of this, it's all well and good to say, hey, we're going to develop this. But when you're looking at something like a townhome, I would imagine it's, kind of that odd intermediary between, true single family and your larger commercial family. So if you're looking to, level land, put up walls and everything, what's some of the kind of challenges with that? Like when you're coming in to do a development, are you mainly focusing on raw land, taking like a neighborhood of like 3 or 4 houses, then putting in these types of townhomes, or is it kind of buying existing townhomes, tearing them down, and redeveloping?
Yeah, good question. And we can, we can talk more about, kind of our criteria, like what we're looking for. But yeah, mostly we're looking for infill land. So infill meaning, we're building in a community that's already, pretty much built up, and we're finding opportunities either through, buying an existing house that's on a bigger lot and tearing that down and adding some more density, or we've been lucky to find undeveloped lots, and we try not to. There's a lot of, in the land world and the entitlement world, there's a lot of money to be made by taking something from like agricultural and rezoning it to multifamily. We just, for the speed, we look for things that are already zoned for what we want to do, and we try to just fit in the box of what the zoning, what the municipality will allow. And we're maybe missing out on some opportunity for adding value, but we're making up for it in speed and just less headaches. And so yeah, we're looking mostly for kind of infill, so smaller lots that are already zoned for what we want to do, for the density that we want, and just working through the city there.
So the high speed, low drag mentality, right?
Yeah, exactly. Yep.
So when it comes to that, what's, I don't know a whole lot about, at least when it comes to kind of the zoning with this, but I would imagine it's, again, kind of an interesting area. You mentioned, finding like a single family home on a large lot. You find a single family home on an acre and a half. Well, you can, increase that density, but what's it look like for the change of use to go from something that's zoned single family to something that's going to have much higher density? Or is the zoning basically just saying, hey, you can have X amount of dwellings per square footage of acreage? Like, what's that look like? Because I really don't know.
Yeah, no, exactly. That's what we look for is, we look for something that's for property that's maybe underutilized. So, we bought a property in southern Utah that it was on about an acre of land. It had an old kind of dilapidated house on it, but the underlying zoning was for multifamily at 20 units per acre. And so, and we just bought the property next door. So we understood like what the city would allow there pretty well. And it was just a way for us to expand. But, I don't know that anyone else or many other people saw that opportunity there to do that. And so, yeah, we bought that property, tore down the house, and, getting ready to start construction there. But yeah, I mean, the challenge is that if you're trying to take it from like a single family zone to a higher density, if the zoning's not already there, you can add a lot of value, but it's also a lot of headache, dealing with neighbors and, cities and planning commissions. And so where we can, we like to just kind of try to fit in the box and look for opportunities where we're not ruffling any feathers.
For sure. Now, when it comes to that, it's, again, there's a lot that kind of goes into that. So you acquire, and let's just kind of maybe use this as a case study. So I'm sure you've probably had some that have come to fruition, but, you close on this house. Certainly it's basically like you bring in the bulldozer the next day, I'm assuming, right? You just tear down the structure,
yeah.
and then, tear down, start doing grading. But there's a lot that has to be done with that. I mean, if you're putting in that, there's going to be new sewer tie-ins, there's got to be new electric pull, there's all sorts of different things. What would you say is kind of the biggest hurdles to jump through with that, and what are some of the biggest expenses that going into the repositioning of a property? Again, using this as an example.
Yeah, that's a good question, and really having the right partners and consultants really helps. And so on the things you're talking about, like utilities and water, sewer, having a really good civil engineer on your team helps with that, because they'll be able to figure out where to connect, what all is involved, what size of meters, everything. And that's all stuff that I don't know, right? That's like way over my head and my expertise. And so yeah, bringing on the right people to understand those things. And so a good civil engineer, as part of our due diligence, we do soils testing. We do a handful of other things outsourced to experts that understand it. So we kind of understand as many of the risks as we can kind of during our due diligence before we close on the property, and kind of wrapping our heads around what the costs involved are going to be, based on, the soils and utilities and all those things.
Sure. So of all those things, what would you say is probably kind of like the the biggest like variable item of what can cost the most? Like which ones are going to jump up and bite you? Is it going to be, which one of the, again, like looking at it when, when you're building a house, you're like, oh man, I really hope the foundation's good, right? It's like, what are those items where you're like, all right, let's really kind of like make sure that this is buttoned up because this one could really bite us.
Yeah, I mean, it's really all the front end stuff. Like as soon as you start, digging holes in the ground, I mean, you can do as much testing and, studies and stuff as you can before that to try to understand it. But you really just don't know until you have an excavator out there, starting to dig holes, what you're going to uncover. And so that's where the biggest potential risk is on any development. Once you've got that figured out, you've got your foundations in, everything else is pretty straightforward from there. But that's the biggest question is in the, we call it land development. So, the grading and utilities, all those things, you don't know 100% what's there until you start actually moving dirt. And so, we build in contingencies into our budget, to try to account for, anything that might come up that's unexpected.
Oh no, that's definitely great to look at. So let's say we're kind of to the point that we've gotten, through some of those bigger ticket items, we're starting to, put things up. What exactly does this kind of look like as far as, how these are developed? What kind of units are you trying to put in there? Are they 3.2s? Are they 2.1s? What is really kind of the sweet spot, at least that you've identified that really is a desirable product for these markets? And is that also kind of constricted by the amount of room you have? I mean, there's probably a lot that goes into kind of identifying specifically what you're looking to put in there.
Yeah, it's a great question. And, one of my partners, one of my business partners is an architect. And so we make a really great team, from the very front end, trying to figure out, okay, what can fit, like, and then to your question, like, what's the best product type to add there and size. And so, kind of going back to my experiences, an appraiser and consultant, really doing the market analysis and figuring out how many bedrooms, how many bathrooms, like what does the market want? And, are there opportunities, or is the market undersupplied on, bigger units, for example? And so a lot of that is market analysis and kind of digging into the numbers and census data to try to figure out, the best unit mix and sizes. And I think that the trend kind of, overall in the development world is going to smaller and smaller units, and trying to just, add as much density and as many units as possible. And we kind of take a different approach where we want to hold these and own these long term. And so we think, that tenants that will want to stay there long term will want a little bit more space. And so we build generally bigger units than average for the areas. We're doing 3-bedroom, 3 baths. We're doing 2-bedroom, 2.5 baths that also have a flex space, like just an open room that could be used as an office or a den or, another bedroom it can be used as. And so we try to think about, like going back again, why did I choose to focus on townhomes? It's, where would I want to live? Where would I feel comfortable with my family? What size of unit? What type of layout? So that's kind of how we think about, unit size and mix and unit type.
No, that's a very good point. Now, do you think that the trending towards the smaller units is based more on like a price point evaluation or just people wanting less space? Because I'd imagine there's kind of two sides to that coin, right? Which one do you think it really kind of is driving that more so than the other?
Yeah, and that's a really good question. And I, kind of had some discussions with some of my friends that are in the, kind of consulting world too. And about, do people really want smaller units, or are they kind of settling for smaller units because that's what developers are providing, right? And I don't have a great answer or a definitive answer. My thought is people would probably in general prefer more space over less, but a lot of the supply has been driven again by by developers and by trying to fit as many units as possible, trying to really increase the density. And one way to do that is smaller units. And so, yeah, I don't know. It's a good question, and I don't have a definitive answer. But my gut is that people would prefer more space over less, and it's just smaller units have been what's been provided.
No, absolutely. And that kind of, makes sense. If the only thing that, that your grocery store is selling is bananas, well, if you're hungry, I guess you're going to like bananas, right?
Right.
Um, it's interesting that would be kind of the case, at least, and it's always kind of hard to tell. It's if you build it, they will come, right? It's if that's the only thing that's available. If there's no homes to buy in an area and there's only apartments, well, people are going to rent apartments. So again, it is kind of interesting to look at it from that perspective. Now, when it comes to, building these, and this is a little bit off topic, but just something I'm just inherently interested in, when it comes to the kind of like how these things are structured, because I've seen, a bunch of different townhomes in my life. Some of them are like different, like standalone units that have like, let's say the building has 4 in it, right? It has, two different ones, or I've seen some where it's just 2, it's one common wall. Is there any kind of like marketing that you do, like analysis that you do to figure out kind of how you like to bunch that density up? Like, is it just a row of 10 townhomes where some people have 2 common walls? Like, what is kind of the more desirable product and what you are trying to kind of develop as a whole in general?
Yeah, that's a great question. And it kind of, comes down to, what can fit on the site. And that a lot of times kind of dictates the configuration of the units. But in general, I think our products are usually in kind of 4 to 6 unit buildings, and part of that is there's a premium in rent for the units that are on the end because they have one less shared wall. They usually have more windows, more natural light. And so, if you can build them in smaller units, you get more of those end units. Smaller buildings, you get more of those end units that can get a premium. Maybe lease up faster because people would prefer to live in that type of unit versus one in the middle that shares 2 walls. And
yeah. So basically it's kind of like building in corner lots, if you will. It's that kind of, like a little bit of extra value add where if you have the density, instead of sticking that one, shoot it over a little bit instead of just, doing that. But I'd imagine that also probably drives into development costs. You have to look at that as a cost benefit because if you do, just a row of 4 townhomes, that's, with that high speed, low drag, it's a lot easier just to build and zip that row up as opposed to saying, okay, we're going to have this 2 unit standalone and this other 2 unit standalone. So do you ever have any kind of like, is that always going to be just a density play, or do you always kind of prefer it if we can, create some more of that built-in value, try to go that way?
Yeah, it's a good question. A lot of it is driven just by density and what can fit, but we also do think about, lease up. So, one of the reasons I like townhomes is, versus a big apartment building is, to be able to move people into a big apartment building, you have to wait for the whole building to be finished, right?
Yeah.
Where townhomes, you're building, kind of one building of 4 to 6 units at a time. And so we do think about lease up when we look at that too. When do each of these buildings deliver, and that kind of dictates how fast we can lease things up and start collecting rent. So yeah, that does go into it too, and into the design of, what is our lease up time going to look like and delivery schedule.
No, that also is kind of an interesting point too, and it brings up a very good aspect of this. Is that if you're in the commercial space, the multifamily space, right, apartments, if you will, you're not going to move someone into an apartment that's still under construction. Whereas this, you finish that one unit, okay, they're still building the one next, the other block next door, but you can still kind of get people in and start making cash flows.
Yep.
I would imagine a little bit sooner than you could in the other direction, correct?
Yeah, and there's also the speed, just because the construction is simpler. We're not having to build, a concrete parking structure or anything like that. And so the speed, the time to actually build a building is much faster than some other product types too.
Yeah, and you also get the you can do it to an extent in single family, but you have to have an economy of scale with having that.
Yep.
One of the nice things about apartment buildings is that, hey, everything's the same. You can buy, every single toilet's the same. So you buy 40 toilets, you buy the same sinks, the vanities, the sconces, everything is basically the same. So you buy in bulk, save money, and it's a little bit easier than saying, okay, well, this house we're renovating with this. You can't put the same countertop in the other one because it's shaped different, right? So
Yeah.
that's kind of a nice thing that I wouldn't have even thought of with the townhome aspect that kind of gives some of that efficiencies of the apartment space down into something that's a little bit more adjacent to the single family market.
Yeah. And going along with that too, just we don't build anything in house, so we hire a general contractor to build everything for us. And the nice thing about townhomes too is, you can pull from, rather than going with a big, commercial contractor, which is a fine option, but building townhomes is a lot more similar, like you said, to building single family homes. And so there's I think a bigger pool of those smaller subcontractors that can be a little bit more nimble. They don't have as much overhead costs. And so you can pull from that subcontractor base as well. And, could save you some time and maybe cost too over, a bigger, commercial construction company.
For sure, yeah, because this is, to have that big commercial, GC involved, there's fewer of them and they also have, they can only take on so many projects at once. Whereas
Yeah.
that GC, it's like, okay, cool. Well, now we just got to get the drywall people out there. And then I have a few other projects where we're just doing, electrical and rough ends, right? So
Yep.
it can, the service providers also become a little bit easier to deal with in that regard.
Right.
So to transition a little bit, I know there's definitely, and now getting into a little bit more of the revenue side of this, there's a lot of different ways that you can, put these out into the market. I know for a fact you can certainly, build them to sell them. You can also build them to rent them out. What is the kind of, and, I think you've been mentioning that, rental is kind of the market that you go towards, but maybe kind of examine why you go more towards the rental side of things versus, build to sell, and why you like that versus the other.
Yeah, another great question. Thanks for asking. And we do that analysis on every new project that we take on. Should we plat it, record it with the city so that each unit can be sold individually, or do we do it as one whole project? And we do that analysis on every project we take on. And there's pros and cons for going each way. But I think where we're at now is, we focused on the rental side for a couple of reasons. A lot of our investors, so we raise money for these projects through syndications. We use, we have people with self-directed IRAs that invest in these projects, and a lot of those investors, there's tax advantages, there's depreciation, there's other advantages of holding a property for a little bit longer rather than just selling each unit. The other thing that's gone into that right now is the difference between what someone can afford to pay to buy a home versus to rent, right? And could someone buy one of these townhomes, and what would their monthly cost be versus renting it? And we're seeing a pretty big gap there, and it's much less expensive by $200-300 a month to rent a unit than it would be to buy the same unit. And then plus you're getting the professional management, professional maintenance, that you don't have to worry about on top of that. And so, yeah, there's a lot of reasons that go into why we've kind of, focused on the rental side. But we do that analysis on every project. We look at, okay, what could we sell these units for individually if we went that route versus, what's the kind of 5-year return look like if we build it, stabilize it, and sell it as one project.
No, absolutely. So from the aspect, because I'm definitely interested in learning a little bit more about this. So from the angle of taking it, saying, hey, we're going to sell these, at least from kind of the structure of this, I'd imagine that there's a lot that goes into, at least even on the permitting side, of being able to do that. So what are some of the differences between what you have to do to position something to sell it versus just to build it up, to tool it up to rent?
Yeah. And I mean, I can give you a good case study. So we have a project, that we're working on. We're just going through the approval stage with the city. We were going to plat those, subdivide them basically so they could be sold as individual units, just to give us some flexibility. Our plan was always to build them and hold them as rentals, but it just gives us some flexibility if things change in the market to be able to sell them as individual units. And the thing that made the decision for us there is, going back to your question, I guess, there's a little bit more time spent on, city approvals. Your civil engineer has to do a little bit more work. But the big thing for us is there's additional upfront costs if you're building for individual units for sale. Each unit has to have its own water meter. It has to have its own lateral, and so there's upfront infrastructure costs, added infrastructure costs if you go the for sale route. And that's what happened on this project I'm talking about. This case study that was our original intent, was to be able to have the flexibility to sell them as individual units. But the city was going to make us do pretty major infrastructure improvements along one whole side of the street that was just cost prohibitive. And so that we didn't have to do if we were doing the whole project for rent. And it eliminated a lot of costs, by those individual, water sewer lines to each unit and the meters. And so, in some ways that decision was kind of made for us by the city and by the engineering department. But yeah, I mean, I guess going back to your question, there's a little more upfront, infrastructure costs if you're going for sale versus for rent. There's a little more, time and effort on the civil, on the engineering side, and on the approval side too.
Yeah, no, that I wouldn't even have thought of, and that's a really great point to bring up, is that the infrastructure cost goes up because if you're building something like a community, yeah, okay, you just have one water meter if it's included in, kind of the, lack of a better term, an HOA fee for that. And then also just from other things the city might say, it's like, hey, we might have to have different ingress, egress, or again, something on the roadway, and then the tie-ins that you're talking about. Also, when you go buy versus rent, with something like this, it's a little bit easier to kind of look at it from an apartment building. Hey, the apartment building has a management company, or it's managed by something. With a townhome, is it something more along the lines? Is it more analogous to having like an HOA you have to build into these things, or is it more along the lines of something like an apartment complex, or is it, again, some type of interesting, unique thing specific to townhomes?
Yeah, great question. We hire. We don't do any management ourselves either. I spent a little bit of time in the property management world, and I learned quickly that that's not where I wanted to spend my time. So
where your expertise lie, right?
Yeah. So we do hire professional, third-party management companies to manage everything for us. And I think property management is like the least glamorous real estate career, but in a lot of ways, it's like the most critical to the success of your project. And so I think, property managers kind of don't get maybe the respect that they deserve, right, for the work that they do. And so, yeah, on our rental projects, we use a third-party management company to, take a lot of that headache off of us. If you were to build it, as individual units, yeah, you would have to set up an HOA. And if you were the sole owner, you would basically control the HOA, and there might be, it's just an extra step, like your management company would have to, integrate with the HOA on some things, but yeah.
Yeah, and that seems like it'd definitely be a headache, would probably be putting it lightly, of creating it. Again, I don't know. I mean, I've never talked to someone about creating an HOA, but most people, anytime you mention HOA, they start getting a little angry.
Yeah.
So yeah, no, that's definitely kind of interesting and some good things to look at from the perspective of people trying to learn about this, that, again, I wouldn't have even thought about of just like, fundamentally you're building the same thing, but there is the utilization is going to drive some pretty significant costs. It's not for nothing to have individual water meters in each unit. It's not for nothing to have individual electric and trash and all that kind of stuff. So it's definitely some things to kind of look at depending on the utilization side, because these things, are not all created equal.
Yep.
Now, looking at it from the rental side, and then, kind of, towards the last 10 or so minutes of this, I'd like to kind of examine, the investment side of this, because I think we've really covered the, specifics of why this makes sense, how these things are kind of done. But as far as kind of the investment side of things, you mentioned that you like to package these, at least as, when you're putting them together, as syndication. So where do these things kind of differ a little bit from, the commercial multifamily space. Again, it's a lot different. And especially when you're talking about something versus, doing your market analysis of this, saying, hey, we're going to buy this to sell it, or we're going to buy these to rent it. How do those things kind of get structured, and what do you try to accomplish by doing it in this fashion?
Yeah, great questions. We settled on the syndication for these partly because we're, like I say, an infill developer, and so these are small projects, kind of 20 to 30 units at a time, and so we're not building 300 units, which would put us into going with private equity and a whole different capital structure. But where our projects are small, most of our investors are here locally, and it's an opportunity. I mean, we feel really strongly that real estate should be open to anyone that wants to invest into it, and so a syndication was a way to do that, to structure it so that someone with as little as $50,000 could invest in this in this project and be part of the team. And so that's how we've set these up, and it's partly driven by that's our projects are too small for like private equity groups that have a lot of capital, and they're too big for a lot of individual investors, and so syndication was the right way for us to do that, to pool a bunch of individual investors together to go do this project that honestly we couldn't do on our own. I don't have a huge balance sheet to go do one of these on my own, and so we need these partners, investor partners, to be able to do these projects.
Oh no, it definitely makes sense. Now, as far as kind of the full the full stack of this, what are some of the kind of the biggest things that are affecting again, being able to syndicate these? Is we kind of touched on in the beginning, but is it the availability of capital? Is it going to be the price of money? And kind of how are you overcoming those things when it comes to actually putting these things together?
Yeah. So how we set these up is we use a lot of credit union debt on the construction side, and where we can, we try to do a one-time close construction to mini perm loan, just kind of lock everything in from the beginning. And we do that because we don't want to. I don't want to put our investors in a position where I have to go back, when it's built, that we have to ask for more money, when we go to refinance. And so we kind of structure these to do everything, kind of lock everything in all at once from the beginning. And we do go lower equity. Lower debt. We're not maxing out our leverage on what we borrow, and so it's kind of offsetting. The cost of capital, like you said, is different for investor dollars versus bank or debt dollars, right? And so we try to balance that, and again, it's really more driven by trying to protect our investors from having to come up with additional capital at some point. So we raise more money on the front end, borrow less debt, which also helps cash flow our debt services less. That's kind of how we structure these. I don't know if that answered your question or not, but that's kind of how we look at it.
No, it definitely does. And also kind of to the point of, it's a little bit of a, with development. Honestly, I just don't really talk to a whole lot of developers in any space. So, digging into kind of the different, portions of the debt aspect, I find pretty interesting, because most people are, it's going to be a reposition. So it's going to be lighter, moderate rehab, but they're not tearing something down to the dirt and then, rebuilding something.
Mm-hmm.
So when it comes to getting, commercial construction debt for this arena, have you run into any issues with it being, again, banks are really used to building apartment buildings. They're really used to people that are building a house or, a planned community. But again, I'm sure there's banks out there that are familiar with this. There's townhomes everywhere, right? You don't just water the ground, they don't pop up. But, is trying to find capital, at least on the commercial debt side of things, when you're going to borrow these construction loans for developing these, is the pool of lenders that are familiar enough with it to, actually come to the table realistically smaller? Or is it pretty available? You just have to know the right people.
Yeah, I think it's pretty available. We haven't had too much trouble, and we have some really good relationships here locally with credit unions we use mostly for this kind of stuff. We use private lenders as well, but yeah, a lot of it is just having relationships and having done deals with these same lenders in the past. kind of built that, trust and relationship. But yeah, we haven't, lenders seem like they understand it, and there hasn't been any pushback in that way from lenders. They're really just constrained on how much they can lend right now, just because of where interest rates are. But I think in general, most lenders are willing to lend and want to get their money out there, put it to work. So we haven't had any trouble finding interested lenders. It's more just balancing, okay, how much can we borrow? What's the debt service going to be? And just kind of working on more like the finer details of how to structure that. But
yeah, and with that kind of leads into my next question of what's typically kind of the price point and the debt equity ratios that you aim for on these things. I mean, I'm sure if a project looks great enough, the sky's the limit for how much you want to spend on something. But kind of what's the sweet spot, or like kind of where do your area of expertise lie, and like total scope of project, like amounts that you're looking at? Is it $5 million projects, 10, 50, 100? Like where does that kind of lie for these types of projects?
Yeah, I mean, total costs, our projects are kind of in the $6 to $10 million range, total cost. And we typically finance, maybe 55 to 60% of that through through like a credit union or another type of lender.
Okay.
And then the balance through equity that we raise through syndications. And we kind of do that. I mean, that's kind of, a couple reasons. That's kind of as much as these lenders are able or willing to lend. But even if they offered us, to go higher leverage, we would still keep it around the same percentage, kind of 55 to 60%, just because we like to be conservative and not push things to the limit. And again, just trying to protect our investors and their investment is why we do that.
I completely agree with that. I think, especially in this market, the more equity you can come into on the rip with something, probably the better. I mean, and generally in any context, that's a good position to be in. Debt is not bad. It has its place. It certainly allows you to get into these deals, but coming into it with like a 60-40 or a 50-50, debt leverage ratio is a nice thing to at least come in from the investor's point of view, because again, it cuts down on the potential need to have capital called at a later date. Granted, every project's different. You never know what's going to happen. But again, that's definitely something that's interesting to aim for, especially in your market. And one thing that you mentioned, again, I'm very green when it comes to this area. I was honestly going to think that you were going to say that these development costs were going to be higher. The $6 to $10 million range, while certainly not pennies, it's a lot. It's a lot of money, when you talk about that. But it's not as much as kind of I maybe thought it would be. Now, when you talk about a $6 to $10 million spread on how much your development costs are, like what's the amount of units that you're typically cranking out? I mean, certainly density, everything plays into that per project. But again, just kind of on an average of what you're looking at, what does $6 to $10 million buy you when you're doing these kind of developments?
Yeah. And a lot of it depends on, where you're at, what the land costs are. So location plays a big part in that, but, and, also unit finishes and, what the type of construction you're doing. So we have a project, that's 24 units. That's kind of in that $10 million range. That one's a little bit more because the city, dictates that almost all the exterior has to be brick. And so in that particular project, the cost per unit, if you're looking at it per unit, are going to be a little bit higher than, say one of our other projects where, the exteriors are mostly stucco and hardboard siding. And so, the design plays a lot into that. And land costs too play a lot into that overall cost. But yeah, when I say, our projects are kind of $6 to $10 million range, we're kind of 16 to 24, 30 units. That's kind of, about the size of a project that we're doing.
Okay, cool. Yeah, that's definitely something good to know for that aspect of it, because again, I just didn't know how much these cost. You tell me you're developing a townhome community and I'm immediately going 10, 20, I'm going in multiples of 10, not necessarily on the lower end of that. So at least from the price point perspective, I mean, one, that makes it probably a lot easier to borrow money. And two, you're not having to raise as much capital to do something like this.
Yeah.
Now, as far as kind of, and again, whatever you feel comfortable kind of answering on this. But again, I like to keep it high level. But as far as kind of what the general structures of the rates of return are, how do these things kind of play out? I'm assuming with the syndication, it's some type of pref being paid to the limited partners. What's kind of the target pref that you're looking at for these projects? And certainly markets, everything dictates this. This is, just very high level of what you can kind of go over of what might have occurred in the past.
Yeah. No, I'm happy to, I'm pretty transparent. So, I'm happy to share. So I guess taking one step back, the way that we look at these projects and the way that we, present them to our investors is, this is kind of a 5-year hold. You need to plan to have your money tied up for kind of 5 years. And so the business plan is to build it, which takes about a year, maybe a year and a half to build it, stabilize it, and then to operate it for 3 to 4 or 5 years, and if there's a lot of variables in there too, if interest rates come down enough that it makes sense, there's a refinance opportunity there where a bigger chunk of that capital could be returned to our investors. But then roughly 5 years is kind of the timeline we've said. Okay, at kind of that point, I mean, let's look at the market, make sure it makes sense. But then we'll sell this project to an investor that's looking to buy a stabilized asset. And so the way that looks for our investors is, again, like we try to give them priority in everything, right? And so the way that the returns come back is it's 100% of the cash that comes back goes to paying back our investors' initial investment, and then they earn a preferred return after that. We're usually kind of in the, call it 6 to 10% range on a preferred return. And then, as the developer, once they're fully paid back plus that preferred return, we catch up a little bit to, some of our fees and our capital that we have invested into it, plus the same preferred return. And then it's just a simple, 70-30 split, anything after that. And so, we try to give, as priority to our investors. Again, like, we really appreciate them. We can't do these projects without them. And, it's a big, for a lot of people, even $50,000 is a big, commitment, to put into something for 5 years. And so we try to structure it to give, our investors priority in everything and protect them as much as we can.
No, absolutely. And it's, especially with something that I'm not inherently familiar with, I kind of assume that would probably be, relatively standard. There's only, when you're doing syndications, things, typically follow a similar, stream down, go down the stream relatively similarly. But it's always good to ask, especially when it's something, again, I never talked to someone about townhomes. So, understanding this is definitely kind of high on my priority list. So with all these things kind of said, I think we've, kind of given a good high level of all this between identification, utilization, things that crop up that might otherwise not really need to be thought about, how you position these things, whether it's for rental or for sale, and then also, kind of how these things are packaged, at least from you as a syndicator and developer of these. With that said, are there any kind of things that we, maybe didn't hit on that you really feel like is a good salient point for people to take away from this?
I mean, just going back, just supply and demand, is what it all comes down to. And I think that the demand for this type of product is growing, especially coming out of COVID, people being kind of cooped up in their apartments for, a year. I think people just want a little bit more space. And so I think a lot of the demand is going to this type of product. And, right now we're in an interesting time where, it's getting hard to be able to buy, if you're going from an apartment to, wanting to buy something, own something, kind of that first step is like a townhome, right? And with interest rates where they are, it's out of reach for a lot of people. And so I just think, we're providing something that the market really wants, and that there's not enough of, honestly. And part of how we decide to, where to build these projects is we do that. We look at supply and demand, and we like to go into places where there's a lot of growth, population, employment. We're in a couple university towns, and so we look at student enrollment, and so places where there's a lot of growth potential, but where the supply hasn't quite caught up. And so yeah, that's my big another big reason why we focused on townhomes is I think there's a lot of good demand there, and there's just not enough supply of it. So
fantastic. Well, I think that's a very good place to wrap this up. Josh, I really appreciate you being on with us today. The most valuable asset we all have is our time, because we can't make any more of it no matter how we invest everything else. So thanks for taking a few minutes out of your day to chat with us and our audience abroad regarding townhomes. I certainly learned something. Always like to learn something in these podcasts. With that said, my name is Alex Perny. This has been another edition of the Alternative Investing Advantage podcast. Thanks for joining with us, and we'll see you on the next one.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.